Welcome back to Behavioral Finance and FinTech. I'm Andy Kim, your Dr. Finance, and here we are talking about the relative valuation technique for valuing Kakao Bank for your term project. Okay, so it's a refresher. What was the relative valuation technique about? For example, just like a PE, price to earnings, right? Ratio, right? What goes into the numerator is about the price that you see, observe in the market. Okay, how much do they evaluate in the market? For each fundamental, right? Fundamental numbers. For example, accounting performance. This is clearly accounting performance because this is EPS, earnings per share, net income divided by shares outstanding, right? So PE, price, this is price, market price, okay? You are interested in how much the investors are evaluating about your company right now, today, okay? Price is observable, but standardizing it by some fundamental numbers. These fundamental numbers come from accounting or economics, right? Some performance related ones or something tangible over there. Something not tangible, is something you really did it, right? Performance related or some profits that you make. It's essentially the same thing. Anyway, so how do we construct those variables, right? PE is one thing. For each dollar of EPS, net income, how much is the market evaluating, right? 6 times for Berkshire Hathaway, 15 times for Samsung Electronics. Now, what other variables would you have, right? PB is also there, which is book value per share. Book value of what? Book value of equity, right? Book value of equity, okay? And then other variables, you saw that there are something called EV to EBITDA and all different kinds of multiples. You see it, right? But for every kind of multiples, you should be able to critically understand it, whether the variable is internally, logically consistent, right? Internal consistency. What do you mean by that? For that part, I need to bring accounting basics, which is nothing but balance sheet and income statement. So, for example, over here, BS, it's not bullshitting, but balance sheet. Left-hand side, debit, credit, right? Asset, and then here's debt and equity. Shouldn't it be liability? Forget about non-interest bearing liabilities, but we care about the financing part. So interest bearing debt is what we care about. Why? Because we are focused on the claimants. Asset is there, factories, and then whatever cash or whatever equipment, all that kind of asset is there. Who claims? Who has the claim, right? The first claimant is the debt holder, the bankers. By law, they have the first claim upon those assets. Oh, fixed assets, when you liquidate it, you have to pay me back first. That's this guy, debt holders. Versus equity holders, we say they are residual claimants. Okay? So two claimants. So balance sheet is about, split between these claim holders and describing those assets, right? How do you do your business? Who are the claim holders, right? And then here is income statement, right? Income statement. And then income statement, where balance sheet is about the snapshot every moment, right? The timeline goes on, right? And then December 31st, 2020, December 31st, 2021, right? We are standing over here, going into the future, right? Yeah. Going into the future, right? Now the thing is, balance sheet is a snapshot at each given time point at the end of the year. And it shows you the total asset, how much is it? This way, right? How much of your total asset is there? Am I standing in the right way? Yeah, this way. Asset, how much is it? And then the left-hand side shows who are the claimants, right? At each given point of time. You show it over here. And then move on, and then do your business. And then next year, you see the snapshot of view of the companies, right? Asset, the debt, and equity, right? Income statement is like a video, okay? Motion picture, right? Over the years, how much revenue that you generated, cost of goods sold, you subtract out of it, then you get what? Gross profit, and then from there you subtract SG&A, and then you get EBIT, right? And then from here you subtract interest expense, and then profit, how do you say? Plus and minus non-operating expense, and then income, right? Non-operating side, for example, foreign exchange, plus and minuses, and then you get what? Profit before tax, and then you subtract out the tax, and then net income. Finally, right? The thing is, those net income, right? Who are the claim holders for this net income? Net income is for equity holders. How about the debt holders? Well, this interest expense goes to debt holders, right? You realize that these income statement, the videos, right? The activity of your companies throughout one period, right? Some item belongs to debt holders and the other item belongs to the equity holders. What am I trying to get at here? Well, the thing that you stick in, right, as your numerator versus denominator, denominator, is there consistency, logical consistency in terms of the claim holders is a big issue. Numerator, PE multiple, for example, okay? The price is this guy. Market value based equity, you can think about market value of debt and market value of asset, right? Market value of equity divided by number of shares outstanding, that's nothing but price. And that's this guy. So this is for equity holders, right? How about EPS? That's this guy, net income divided by number of shares outstanding. Make sense? So that's equity side claim holders, equity claim holders, right? So internally consistent, right? For equity holder side, how much they get as a profit and how much is it evaluated in the market. Good to go. That's why PE is so popular. How about price to book ratio, right? Price, again, the same thing. It's the equity holder side. This guy, right? Market value. And then the denominator book value of equity is the very book value of equity holder itself. Internally consistent. This is just the market value of equity over book value of equity. Yeah. MTB, some people say MTB, market to book, academicians, but in the industry they use it PB, right? And this is precisely what you use for value stock versus growth stock. You remember that Pharma French argument, right? There you had book to market, right? Book to market was just a flipping of it, right? You remember that? This one went into the numerator and that guy, price, went into the denominator. That was it. Now, EV to EBITDA, right? EV, what the hell is that EV, right? By the way, before I forget, let me write down something over here. PS, right? PS ratio. EV to EBITDA, okay? Or value to EBITDA. Okay? Again, the denominator is a fundamental number, okay? Coming from this way over here. Well, EBITDA, what is that? Well, that's starting from EBIT plus depreciation and amortization. That's EBITDA. That's EBITDA. Right? You see that? EBITDA. I should stop this one. Anyway. So operating income and then adding back the depreciation and amortization. What was the idea? Well, depreciation and amortization is a non-cash expense. Whereas what you care about is operating cash flow. Day by day, right? Based on your day-to-day business, how much cash do you generate, right? If your business is H&M, your day-to-day business is selling clothes, right? Selling fashion goods, right? If your business is 삼다수, your day-to-day business is selling this water, right? That's operating income. But not only that, there must have been some depreciation and amortization, because to produce this, you must have built up your factory. Like 10 years ago or 20 years ago, maybe, the company must have spent huge amount of money to build up their facilities, buy the land or rent it, or the factories, and then equipment, the pressing machine, and then the water extractors, pump it up, the pump. Did I say extractor? Pump, water pump, and then all these kind of things must have cost a lot of money. We call it investment, right? But the thing is, you don't expense those investments right away. We say matching principle, okay? Your expenses has to match with the revenue generation, okay? So initial investment for this production has happened hugely. The cash outflow happened hugely in the beginning, right? But the revenue generation took place over 20 years horizon. So how would you split that investment and recognize it as a production cost going into the future? That is what we call a depreciation and amortization over here. And those DNA, okay, depreciation and amortization must have been somewhere here and there. Cost of goods sold and SG&A, they split it, right? CPA guys know too much about it, and then they will give you a hard time about, what DNA, guys, I like blah, 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 blah. And then, yeah, you are right. Okay, take that. So that's that, right? The thing is, because this is non-cash item, just bring it back so that you will recognize, you will now understand how much of a cash the company have generated in those 1 year period over the business, okay, based on that income statement, okay? That's EBITDA, and that's a fundamental number, right? That's a performance. How much cash did you generate it, right? So bring that EBITDA into the denominator. For each dollar of EBITDA, how much of a price do you get, okay, or market price can you get in the market? But instead of price, what you get is what you have is over here something called value or enterprise value, EV, okay? So first thing first, value. What is that? That is market value of assets. This one, value. This is market value of asset is value of a company, okay? MVA. Then that's market value of debt plus market value of equity. The balance sheet identity, right? That's that. Then how about enterprise value? Enterprise value? Well, that's value minus cash. So market value of debt plus market value of equity, that's this guy, and then subtract the cash out. Why do you subtract the cash out? Because cash is not helping or doing any business in your day-to-day business. The cash the 삼다수 has in their balance sheet is sleeping on their bank account, not doing anything for selling this water. Okay, it's just earning interest on their bank account, stuck into the treasuries and all this kind of safe assets, not adding any value to the company's day-to-day business. So let's subtract it out. That's the idea of enterprise value. This whole thing, something directly related to the day-to-day business. This market value, let's call it enterprise value. Add cash back, this guy, right? Balance sheet amount of cash. Anyway, so that's the difference between these two. But the thing is, getting back to the consistency issue, is this multiple or that multiple consistently defined? Numerator, denominator. Let's check it. So enterprise value, this guy, okay? Who are those claimants? Debt holders as well as equity holders. So I should say this is for debt and equity holders. How about EBITDA? That's this guy, EBIT plus D&A. So this cash flow is going to be spent to debt holders as well as equity holders together. It's operating income essentially, right? Part of it will go into the debt holders' pocket, and then the remaining part, some of it will go into the equity holders. So it's for both debt and equity holders. So it is consistently defined. Okay? Good multiple. How about this one? The same thing. It's debt holders and equity holders for numerator, equity holders, and the same thing for denominator as well. So it is consistently defined, right? So these two guys also pass our criteria. Good, consistent one. Now, PS ratio, price to sales ratio. What is that about? The price is about equity side, market cap. This guy, right? The same thing. How about S? This is sales, right? The sales, that's nothing but the revenue over here. Okay? Whether you call it revenues or sales, it doesn't matter. But they say PS ratio. Okay? Before I move on further, why do people use PS ratio sometimes? Okay? Why? When do we see that? Well, that's because there's a limitation of using PE ratio. This is the most popular one I told you. Okay? But there is a limitation of using it. When is it troublesome? When net income is negative or zero. Okay? When this guy is zero, okay, net income is zero. Denominator being zero means the whole number explodes to infinity, right? You cannot compare. It's like, and then another trouble is when this guy is negative. When you're a loss-making company, okay, negative EPS, negative PE, is it any meaningful? No. Okay, if you use negative, let's say, negative 20 times PE, what does this mean? For each dollar of loss that you make, the market evaluates it to be $20. Oh, that's a great company. Is that? No. It's meaningless, completely meaningless. The thing is, many of your bosses still use negative PE ratio because they forgot about this. How could that happen? Once you get older, you will realize you will be one of them as well. Forget. So you have to convince your boss not to use this kind of thing. Okay? When this guy is negative. when loss making, right? Then if it is loss making negative, then what would you do? What would you use as your denominator instead of this one? Okay, you have to throw out PE and then use some other multiples like alternative ones. One way of doing it is going up the income statement step by step. Profit before tax could be there, or operating income could be there, or using EBITDA could be there. Gross profit could be also there, or some people go to sales all the way up. Why? Because sometimes they make not just negative net income, but also negative operating income. Okay, when your company is very troublesome or very young, right? Young companies like Amazon in their early stage, they were making huge loss. Operating loss was there. You would not be able to use EBITDA multiple there. Then what? Gross profit could be there, but even the gross profit could be gross loss. Then what? The sales. So you could use sales, right, as a denominator over here. That's the idea. That's why a lot of people use the PS ratio during the dot-com bubble period to evaluate those companies. But the thing is this multiple consistently defined for average companies? Price is about equity holders, but the sales is about what? Sales is for both debt holders and equity holders. Some part of it in the form of interest expense will go into debt, right? So it's inconsistent because it's equity plus debt. It's not good. Okay? For usual companies, it's not good. But why did people use that PS ratio during the dot-com bubble period? Because those startup companies, do they have any debt holders in the first place is a question. Usually for startup companies, dot-com companies, they cannot borrow any money because it's too dangerous. The banks will be like, go away, no way. And then they will only have equity holders. That's why they could safely use PS ratios. But for other companies like Samdasu or whatever, Brooks Brothers or whatever, it's not recommended. Okay. So consistency test is something that you have to always do to check your logic over there. And then the other multiples, value to EBIT, value to cash flow is also there. Book value based ones, right? Price to book ratio and all these kind of things are there for you. And go ahead and read those slides for this, right? And then the next thing important is about the analytical understanding about what is the driver of these multiples, right? What are the drivers of these multiples? Drivers, what do you mean? The fundamentals. PE ratio, for example. High PE ratio versus low PE ratio. I said compared to average. If it is high, let's say this is overvalued, and let's say that is undervalued. But is that all? First round answer is yes, but the second round you'll be like, more sophisticated guy will always say, nah, that's not it. Because some companies deserve higher EPS, higher PE. Some companies deserve lower PE. What do you mean by deserving, right? That's what I mean, driver, okay? What drives the companies to deserve certain PE ratio level, okay? The driver should come from the fundamentals. Fundamentals like cash flow, risk, and all these kind of things, right? That part I'm going to talk about it in the next video, so watch that. Thanks for watching.